Welcome to another episode of Credit Update from Capital Advisors Group. In this episode, I'm going to discuss ESG investing, the new buzzword in cash management community. Now, ESG stands for environmental, social, and governance, the three pillars in measuring sustainable and ethical impact of investments. Before this new moniker, responsible or sustainable investing has been quite popular among equity investors for several decades. It was only in the last decade or so that momentum started to gather in the fixed income world. The introduction of several money market funds catered to the green, impact, sustainable, or ESG crowds marked the formal entry of ESG investing in the cash management world. As an investment manager of corporate and institutional treasury balances, we are walking down the same path as many of you in trying to get a better understanding of ESG investing, specifically how to engage these sustainable investing principles in our space on a day-to-day basis without compromising our safety, liquidity, and yield objectives. We published a white paper, Demystifying ESG Investing, in the summer of 2019. We included ESG as one of the three trends to watch in 2020, and we'll probably do it again in our upcoming outlook, thanks to the impact from the COVID-19 pandemic. More recently, we posted a blog on how one goes about getting started down that path. I think you should check out these resources on our website. Now, let me use the segment to cover three items: defining ESG, applying to fixed income, specifically institutional cash investing, and how to choose data providers to help making those decisions. Now, a little bit of the definitions should help. First, SRI. The term ESG has been a relatively recent phenomenon, but responsible or ethical investing has been around for a long time. The Hebrew Bible has rules governing ethical investing about 3,000 years ago. The socially responsible investing, or SRI, was introduced to the United States by the Methodists, and then later the Quakers about 300 years ago, to restrict investments in liquor, tobacco, gambling, and the slave trade. So SRI is exclusionary, meaning it wants to screen out undesirable investments to influence industry behavior or investor behavior or asset behavior. Now, the second type of definition is impact investing. In the last 20 years or so, a new approach called impact investing has garnered some following. It likes to invest with candidates based on a set of criteria that can be positive, that can have positive impact on the environment or gender equality or racial diversity or democratic social institutions and so on. So impact investing is inclusionary, meaning it screens in the candidates with positive attributes. And then there's ESG. The ESG approach calls the public attention specifically to environmental, social, and governance issues that the asset management industry can help towards a better future for the planet and for humanity. Where the term was first introduced was also where the whole sustainable investing trend received a major lift under its wings. The United Nations sponsored Principles for Responsible Investing, PRI, study in 2004. Now, along with its findings, the PRI group invited asset managers and owners to join hands to understand and solve the ESG issues by becoming PRI signatories. Today, there are over 3,000 signatories, representing over $100 trillion in assets under management from the asset managers and asset owners, as I mentioned. Now, I want to end this segment by saying that we may hear terms like ESG or responsible, sustainable impact investments. They may or may not be interchangeable, although the general goals may be consistent with each other. It's just that we need to do a bit more work to figure out which approach works for us. Now, applying ESG to fixed income and cash investments. First, the debt market. Although the fixed income world had a late start, it has caught on quite quickly because of the larger debt market relative to equity market cap. This is especially true in the issuance of green bonds and later the social bonds to finance specific ESG-focused initiatives and projects. The green bond market is only a little over a decade old, but annual issuance is expected to be more than $1 trillion. Social bonds also caught on quickly. Bank of America, Citigroup, JP Morgan Chase, Morgan Stanley, all brought some social bonds to market since the pandemic this year. And the year-to-date issuance has already reached over $100 billion. In the cash management space, we're seeing more money market funds being started or converted to green, impact, or ESG funds. However, ESG investing for cash portfolios has its unique challenges. Here are a few things to think about. Uneven exposure. First, most of the eligible cash instruments besides Treasury and agency securities are corporate and bank debt, with a few exceptions such as the automotive finance or integrated oil and gas companies. Most of the so-called dirty or polluting credits do not meet the high credit ratings for cash portfolios. Conversely, bank credits are heavily represented with generally lower environmental exposure. So in a way, ESG impact studies lean more heavily on board governance and regulatory compliance issues for cash portfolios. And these are generally already addressed in fundamental credit evaluation process. The concentration and liquidity issues. By the same token, because of a finite group of eligible issuers, we may not have the luxury to exclude too many issuers from ESG portfolios. Raising the ESG score may come at the expense of higher credit risk diversification and lower portfolio liquidity. This trade-off should be carefully considered. Now, at Capital Advisors Group, our number one rule towards ESG investing is, if an issuer does not meet our credit standard, it will not be approved for the ESG portfolio, regardless of how high it scores on ESG. Another issue is transparency. You see, standardized ESG disclosure is a work in progress. It is particularly challenging in terms of transparency. For example, when we say banks have less environmental impact, it is only partially true because the largest asset group on a bank's balance sheet is private loans that are not rated by rating agencies or disclosed to the public. We have no way of knowing the ESG characteristics of these underlying assets on banks' balance sheets. The same is true with asset-backed commercial paper or asset-backed securities, as these are instruments backed by pools of assets that do not disclose ESG information. One day we may know more, but we're not there yet. Number 3, selecting ESG data providers. Now, having understood the trend, the needs, and the challenges in ESG investing, the next step down this path is to find the right data for our decision making. This is the specialized area of data gathering that most asset managers and owners use some kind of outside help. First, lack of ratings regulation. There are quite literally more than 100 ESG data providers, sometimes called rating agencies. Each has its own collection methods, screening criteria, nomenclature for ratings, scores, grades. By now, you probably have heard of names like MSCI or Sustainalytics. Major financial data providers like Bloomberg and Thomson Reuters are also in this space. Now, credit rating agencies like Moody's and Standard & Poor's and Fitch Ratings, which are actually nationally recognized statistical ratings organizations, NRSROs, are registered with and regulated by the Securities and Exchange Commission. But ESG data providers don't have such a regulating body, so each has its own ways of measuring things. The final score can be quite different on the same issuer from different agencies. Number 2, quality of disclosure. Now, before engaging a specific ESG rating firm, we need to first ask them about the way they collect their data and the reliability of the data. For example, standardized reporting mandated by an edict or information collected by a third party is generally more reliable than voluntary self-disclosure. publicly disclosed data to all investors is generally more reliable than private data released only to the service provider. Regularly reported data series are more reliable than the ad hoc reporting, so on and so forth. Number 3, standardization of the methodology and reporting. We are glad to see that more efforts towards standardization is taking place. Organizations such as the UN's Principles for Responsible Investments, the Global Reporting Initiative, and the Sustainable Accounting Standards Board, the SASB, are laying the groundwork for uniform, consistent reporting of ESG data. Data providers that use standards and methodologies compatible with those global initiatives are more likely to prevail in the future as these practices converge and consolidate. Number 4, integration of ESG methodology into investment philosophy. So when evaluating service providers, we need to think whether the way that they approach ESG risk is compatible with our own risk culture and investment objective. Not all ESG risk is equal. For example, methodologies and scores that help us identify emerging risk that is material to investment decisions may be more valuable than those that simply provide an overall risk score. And investors that are more concerned with environmental risk may find providers with strengths in that area more desirable. This integrative frame of reference away from pure risk to impact on investments will lead to better investment decisions that satisfy the main mandate of cash investment strategies: safety, liquidity, and yield. That's it. Thank you for watching this episode of Credit Update on ESG investing. Stay tuned for more on this and other cash investment topics from Capital Advisors Group. I'm Lance Pan, Director of Investment Research and Strategy.